Howdy, folks. This Canadian stock that is yielding well over 7% is probably one of the most controversial in the Canadian economy, and I am talking about Enbridge. I want to break down this stock. Can they afford the dividend? Is it on the verge of bankruptcy as it has been replaced as Canada's third largest company by Shopify and Canadian National Railway, even though it's only been surpassed by about $1 billion or so, a couple billion in market cap valuations, and it's all because of this pullback, this fear of high interest rates driving these infrastructure-based companies into the ground. And we're going to see how much interest Enbridge is truly paying because of this higher interest rate environment. But the stock is down 20% from the all-time high it hit in the midst of 2022, currently driving the yield up to a whopping 7.6%. I think it's important to point out the last time it paid this was only during the pandemic, and this company's yield has been just continually going up to records, like absolutely absurd record. I mean, most people just expect average rates of return usually around 8%, and that is pretty much what Enbridge is giving you right now. And the only thing that makes this pretty much one of the most insane dividend stocks, well, the most insane Canadian dividend stock, is it has increased it dramatically over the last 10 years without a cut. I mean, it's gone from 32 cents all the way up to a whopping 89 cents, and over doubling of the dividend. There is anticipation that they can't sustain this kind of dividend growth into the future, and it's likely this is going to slow down over time. In fact, we're not seeing the big jumps we saw through the the midst of the 2000 teens. Now we're kind of just slowly jumping up basically year over year. No big jumps like we've seen here, right, even into 2020. But is that going to change? It could very well, potentially, thanks to this recent acquisition that they're have this definitive agreement to basically acquire Dominion Energy, or at least some of the East Ohio gas company's assets, which is very intriguing because this is costing them about $14 billion. And what's most insane about this is it's going to create North America's largest natural gas utility platform. If you believe the renewable future and is largely going to be proponented by natural gas, which so many companies are leaning into, this just gave them a massive foothold in North America over this.
He is the president and CEO of Enbridge. And Greg, welcome.
Thanks, Becky. Great to be here. There is no positive energy future from a sustainability perspective or affordability perspective without that gas. So we've already been in the gas utility business, and now this will create the largest platform for natural gas utilities in North America. And this really is just a great opportunity for us and our shareholders, and we'll continue to be able to grow the dividend, grow our earnings on a go-forward basis. So very exciting.
You think you got a better price because of all the concern about what regulators are doing? You think you were able to be opportunistic here?
Well, I think there are several things. One, our size. So there aren't very many people that could come across and buy in 3 individual states. With the financial wherewithal to do that. I think you're right. Maybe a little bit of a contrarian play on some of this, not from our perspective, but from some other perspectives. And then I think you had a buyer that was motivated to focus on other things and largely on the electricity side of things, and that created an opportunity for us as well. So when you already run gas utilities, when you already run gas pipelines and liquids pipelines and renewables, it actually fits our portfolio extremely well.
If you live in the city of Toronto, you go around the GTA and you go to the behind buildings that are basically heated by natural gas, and you look at the meter, typically it has an Enbridge logo on it, and they paid a fairly reasonable value. Basically the multiples were based on a 2024 estimate of 1.3 times enterprise value, and basically their 2023 estimate of about 16.5 times of a price to earnings multiple, which I guess most could say is fairly favorable. You're kind of trusting management that they did a good position on this, and this caused further controversy in the stock because it led to further share dilution expectations and a lot of things like that. So the stock has just been tanking, and people basically are calling this a bankrupted company, which blows my mind because we're going to get into it. Now, Enbridge is most famous for basically being the largest infrastructure pipeline company globally. I mean, their pipeline spans pretty much all the way from Alberta down to Texas, and they have been investing in the renewable future as well. Obviously getting into some of the offshore wind projects in Europe. They've got a lot of wind in North America, getting into some of the solar panels. This is a fairly small proponent of their entire portfolio, but again, they are kind of pushing into these new vectors, which honestly I think aren't the biggest growth vectors right now. There's a lot of hindrance because of the debt that comes with this, and the renewable sector has been getting absolutely slaughtered as of late, as far as I can tell, across the general sector. But we're going to kind of get into some of the dividends, and we're going to talk a little bit more about the debt and just what's on the balance sheet. But I highly, implore you guys to kind of just scroll through the investor deck, because this company's got a lot going for it. So you can see the renewable power gather here, gas distributions, also a fairly small proponent with liquid pipelines making up over 50% of the business as it stands today, right? But take a look at this because we're going to get into the second quarterly results, and this is where things get so intriguing to me because yes, the company has been slowing down a bit, and I think that's because gas has pulled back. We can see the total operating revenue here has dropped basically year over year from 13.2 billion to 10.4. That's kind of sketched investors out a bit. That led to selling in the stock price. We can see on the 6-month basis from 28 billion to 22 billion. That's not the best thing we can possibly see, obviously, because this is an infrastructure-based company. What I always like to pay attention to is the depreciation and amortization costs, which amounted to 1.1 billion basically just for this quarter alone, which is a pretty mounting amount of amortization and depreciation costs because, again, it's like buying a car, guys. The car may lose value over time, but it'll always generate the same revenue. If you're an Uber Eats person, you can write that off against the revenue and not pay any tax. It's not like a direct effect on the cash flow. And the reason I state that is it comes into a big deal when it comes to the dividend, right? So if we take a look at the common share dividend declared of $1.7 billion, we can see that their net income can currently actually sustain that. If we take a look, their earnings attributed to common shareholders was $1.84 billion. You tap on the fact that they wrote off $1.1 billion of that cash flow. They do actually have a sizable amount of room, even in this slower revenue environment for them, that the dividend is likely sustainable here. Again, this could change over time, but I'm really intrigued to see when this acquisition comes into full tuition here. We get an idea of what that does to their actual cash flows and revenues. But again, it's something to pay attention to because people are just buying this for the dividend. I mean, that is a full year rate of return just from a dividend yield, right? Taking a look at the interest expense, it's sitting at 883 million, which is up from 791 million. And I'm curious to know what their debt looks like because basically if they have locked in line of credits or some kind of locked in debt that has an amortization period to it, it'd be neat to see when that comes due and how that can affect the debt. But if it's just a revolving line of credit, they've already experienced probably massive increases, and we're seeing those increases go up because I mean they're on the 6 month at 1.78 billion versus 1.51, which doesn't seem as dramatic as it probably should be. So I'm really curious to maybe do some deeper digging and figure out why the debt hasn't gone up as fast as perhaps a lot of other companies have seen, especially companies that have like mortgages or own real estate or have those aspects attributed to their business. A lot of warehousing companies are dealing with stuff like that right now. Take a look at their assets sitting on 173 billion or almost 174 versus 109, almost 110 billion in basic liabilities here, which very, very intriguing stuff because that gives them an underlying asset value of what? You minus that, it's what, maybe 60 billion, and their current market capitalization sits around 99 billion. So they're trading a bit above their underlying asset value, that NAV value. But this is just one of these insanely controversial stocks. It hasn't done anything since 2015. Technically, from the all-time high, it's down about 27%. But if you're buying this company, you're really buying it as a dividend player here in Canada. And I'm so curious to what you think because I love that I get exposure to this through my monthly paying ETF, VDY. I've never really wanted to buy it on an individual basis, but I've always been hyper intrigued by it because it's always been just one of Canada's largest companies, and it only takes a little wave to the upside, and it'll be well above Shopify and Canadian National Railway again. But I have a good understanding that this company will probably be in the top 10 for a very long time to come. But I'll pass that question off to you. I'd love to know what you think about Enbridge stock in that comment section below.